Good afternoon, everyone, and welcome to Henderson Rowe's Tier 1 Investor Visa webinar today. My name is Kevin Reid. I'm one of the investment managers with the firm, and I'll be speaking with our senior investment manager, John Whick, who heads up our Tier 1 department, along with Professor Phil Wall, Head of Investment Solutions at Radiant Global Advisors, our parent firm. Now, today's discussion will be looking closely at recent trends in the Tier 1 investor field, current challenges and solutions for Tier 1 investor visas, the UK investment risks for Tier 1 clients, and mitigating those risks with institutional quality portfolios. That will be followed by a Q&A section at the end of the call. Now, today's discussion will be in a question and answer style format, and I will begin with John. But before I do, John, did you just want to introduce yourself briefly, please?
Yeah, hi, Kevin. As many of you know, I'm John Whick, Senior Investment Manager here at Henderson Rowe, and been working on the Tier 1 investor visa side of the business for about 10 years. So really exciting to have everyone here. Thanks very much for coming along. It's also exciting to be in an office, believe it or not, and wearing a suit. And I can confirm that I'm wearing a full suit, not just the top half with a shirt and tie, as often the Zoom meetings are nowadays. But yeah, very good to be here, and obviously great to see you too as well, Kev.
Brilliant, thank you, John. Well, I'll get straight to it. The first question, John, we all know the impact that COVID-19 has had on the economy and general business. What are the most noticeable developments that you've seen specifically in the Tier 1 space since the beginning of this year?
Yeah, so good question. And I think like most businesses over the last year, a lot of it relates to just there being quite a big pause in workflows. For us, definitely March to July, everything just ground to a halt, really, particularly on the Tier 1 side. And that really related to whatever part of the process, whatever stage you were in that process. So yeah, absolutely, things ground to a halt. We've seen a reasonable strong pickup actually since July time, which is quite interesting. So yeah, clearly a slowing. I'm sure it's been the same with all of our partners in their business areas. That also, I think, added into what we identified as a kind of slowing and a pause in the kind of interest coming from Hong Kong, somewhere we do a huge amount of work because of our connections out to Asia. As we all know, from January 31st next year, for £250, if you've got a British national overseas passport, you will be able to come over to the UK. So there's a whole host of people who previously may have been doing the Tier 1. Actually, they can now get the settlement over here through that route, which clearly is a huge difference in terms of expense. So in terms of the recent flows of business, I think those are two things which are quite important, have played quite a big role in quite a large pause in the Tier 1 business at the moment.
Brilliant. Well, following that, John, what I would be interested in knowing is, have your clients faced this with optimism? Do they view this as an opportunity, or would you say that clients are still cautious with regards to obtaining the visa?
Yeah, so as you all know, we work with UK clients and international clients alike on the Tier 1 side. For a lot of those UK clients, falling markets are seen as an opportunity. With regards to the Tier 1 clients, it's certainly been dealt with a lot more caution. So yeah, we've seen people holding off. We've seen people taking a breather in terms of their plans. Whereas for the more entrepreneurial investors who may be UK based, they're the people that may be looking at the market move with a bit of optimism. I get the sense that is starting to change at the moment, but there is caution, I think, around the Tier 1 visa emanating from other areas as well. As we know, since Samira Hajieva was landed with her unexplained wealth order, very highly publicized, I think that's created a degree of concern around particular areas where traditionally you'd see quite a few applications on the tier one investor visa. So that, I think, as well is an area where you're seeing caution with regards to coming to the UK. For us as a firm, as many as you will know, we've always prided ourselves on doing a very high level of anti-money laundering, but doing it concisely and swiftly and fairly. We think that's incredibly important. So from our perspective, the kind of overview that or the political backdrop that some of these people are now taking with regards to tier one clients and being a little bit sharper on the AML, I think we generally would support that. So absolutely, there is a degree of caution, I think, emanating from different areas with regards to tier one at the moment. The other thing as well, which is quite interesting from our perspective, and I'm sure many of you know and recognize that over the last 10, 12 years, the tier one investor visa has always been a kind of route that has got busy when particular regions around the world have experienced instability. That's something which we're currently seeing on a global level. And certainly I have a feeling, and I think this is shared with some of the people that we work with, that given that we've got that global instability, people have just started to reassess what their plans are going forward. So it's the biggest global instability that I've ever lived through, probably the same for the most of us. And as a result, lots of people around the world are starting to reassess where they might be spending the future with their families. And the tier one is a great way to allow accessibility to a country if you've got the funds. So I think just the fact that we've had this global change and this huge global event, I think that's created a lot of interest in the tier one. And we're starting to see that come through. And we're probably as busy now on that front as we've ever been.
Brilliant. Thank you, John. The next question I've got for you is, what are the main challenges for tier one investor visas, given the situation we face with COVID, and how would you suggest we overcome those?
Yeah, so that's an important question, because clearly all of these changes mean that the processes that people have to go through, and indeed the timescales, essentially have changed. So with regards to COVID, I think the one thing that we've seen, which is particularly challenging, is the things that normally would be quite simple in the process. So document certification, collection of documentation, the logistics around actually getting everything in place. So in that context, there are some real challenges. I think we had one case that we were dealing with after July, and it took a good month to 6 weeks just to arrange to get a lawyer in a room with someone to certify a very simple document. So that's one side in terms of the challenges. The other element as well is simply travel. As we know, huge restrictions on travel at the moment, and they're changing week to week, month to month. So where people previously would have come and visited the schools that their children would have been at, or had a look at the properties that they were hoping to purchase, that's all been thrown up in the air. So how do you deal with that? Well, I think a really big part of the message we're trying to get across today is start things as soon as you can do. That's incredibly important. If you do that and you give yourself long time scales and don't put yourself under pressure, then you will overcome a lot of these challenges, because we don't know what will be happening in the months ahead as well. So that's one thing. The other thing as well, and this is an area where we can really help people, certainly with regards to visiting and the kind of physical movement, having good, strong networks is incredibly important. So we work with the biggest IFA network in China. We work with a number of people who will help clients with schools. And indeed, we've got property contacts as well, as I'm sure many of you do. So using those networks is a key way to actually overcome some of those challenges around the physical movement. So yeah, I think on that front, the key thing get things done early, and use the networks that you've got at your disposal.
Thank you, John. In the news, there's been a lot of mention of the China-Hong Kong relations and the January 2021 announcement. Could you give us your take on these developments, and how does Henderson Rowe plan on being able to respond to this?
Yeah, so it's a really interesting one, this. Obviously, we've got great connections out in Hong Kong, and I'm out there relatively frequently, hoping to be out there next year. As I mentioned earlier, the thing that you would expect is that you'd see this pause as we've seen, and then maybe expect to see business completely drying up from Hong Kong because everyone's now coming in on a £250 visa. I think they expect something like 500,000 people to apply over the course of next year alone. So you'd expect, maybe suddenly Hong Kong becomes a bit of a desert with regards to business. However, I think there's a flip side to this narrative, which is that essentially what's happening between Hong Kong and China, it's demonstrating that there's a hardening of the stance between the two countries. Now, if you're not a British national overseas passport holder and you start to feel trepidation about what the Chinese government is doing, actually it could spur you on to want to accelerate a movement overseas. So that's interestingly something which we, I think, are starting to see. So while we've seen that initial pause from Hong Kong residents, now that we know the situation going forward, actually it's starting to create a reassessment among the wider community, and we're starting to get more inquiries there as well. So just with regards to the hardening of the stance, how do you deal with that? Well, as we all know, it's very, very difficult to get money out of China. In fact, explicitly within the rules, it's really pointing to the fact that you can't do anything which undermines the legal regulations with regards to moving money out of any particular country. So that's a huge challenge. Again, one of the key things to overcoming this is to make sure you talk to the investment manager, such as ourselves, really early. The regulations that we have to adhere to, which are the FCA regulations, are actually a lot stronger and a lot more rigorous than the guidance that is given out by the Home Office. So in that respect, talking to us early on, identifying where you might have funds that you could move and which funds will be easiest to move is really important. It will also allow you to give that an offer and suggest that tax advice, which is increasingly important, just to make sure that you're not moving money around, which ultimately leaves you in a worse situation than if you were moving money from a different pot. So yeah, I think the UK-China politics is an interesting one, and it's something that we're watching closely, but I don't think it's going to be a death of the Hong Kong business by any means at all.
Okay, a lot of useful advice there, John. Now, I couldn't not bring up the B word. In your view, what impact do you think Brexit will have on the tier one investor space?
Yeah, so I think we'd all share a kind of opinion that it's been great to have a bit of a break from the Brexit news flow. That will probably change over the next few weeks as we get to the end of negotiations, if they're going to end successfully or not. But Brexit, I mean, essentially Brexit is an investment challenge. And what you've got now is you've got a country in the world that's just been hit by a pandemic, and it's also being hit by a huge potential shift with regards to trading relationships. So this is very much an investment challenge. Now, in the context of that, we are no longer, as people who work in Tier 1 Investor Visa, we're no longer in the situation where we can comfortably go and put all our money into gilts, leave it for 5 years, and we're all very happy. Maybe the gilt income has covered fees, and no problems, very easy to do. Given that we've got Brexit compounded with COVID, you have to you have to really drill into what you're doing on the investment front. You have to be doing it in a way that is measured, where you're using real experts in the field, because Brexit is combined with COVID, it's a huge challenge. Clearly, a solution to that is using people who really know what they're doing. Historically, we've always been very strong in investment in the UK space, and working with Radiant, who are really leaders and pioneers in the field, that only reinforces that expertise. And it will be interesting hearing from Phil later the degree to which really, we work at the cutting edge of investment. And that's what we deliver to our tier one clients. So yeah, absolutely. That's something that we'll hear about later. But when you have those economic challenges and those investment challenges, you absolutely have to focus in on the quality of the investment work.
Absolutely. John, the final question I've got for you today is COVID-19 has certainly caused waves in the investing world, with stock market indices selling off and then regaining ground. What's been your advice to existing clients surrounding this?
Yeah, so I think the first thing comes back to looking at those kind of timescales, how they've lengthened out, because actually where we have had a few people who've come on board over the last year or so, the temptation was certainly to get invested early. Now, as we know, we can invest up to 12 months ahead of the visa actually being awarded, and the temptation's there. Now, we had one client who the application went in and chose to invest while markets were low, while they were taking a beating. And actually, it's only in recent weeks that they've had the confirmation of the visa. So I think my inclination at the moment would be, well, there may seem to be an opportunity. As always with the tier one, always err on the side of caution. So maybe don't be too eager to invest until you've got the visa. The Home Office timescales, absolutely, they're dragging out. And if we've got 500,000 people who are about to start applying from Hong Kong, then I have a sense that things might get a little bit busy in various departments across the Home Office. So I think being cautious on that side is really important. Beyond that, clearly there are many investment challenges. This comes back to the issue of Brexit. And I think, whether that be foreign exchange rates, whether that be individual country risk, credit issues with regards to bonds, there are many investment challenges. Now, it's on that note that it's my great pleasure to hand you over to Professor Phil Wool, a colleague and a friend, and he's very much more qualified to take on board and talk you through some of those investment challenges, and indeed how we pride ourselves on overcoming them for our clients.
Thank you, John, for the discussion just there, and thank you, Phil, for joining us today. It is a real pleasure having you on our call. Before we begin our discussion, Phil, would you like to just introduce yourself briefly, please?
Yeah, sure. So my name is Phil Wool. I'm head of investment solutions at Radiant Global Advisors, the parent company of Henderson Rowe. My team is responsible for building the models and the processes that drive client portfolios at Henderson Rowe, and that includes the tier one investor visa portfolios. So a big part of my role is to research and implement enhancements to that process. But another part of what I do as head of investment solutions is to talk with our clients about our models and about markets. And so I think this is a good opportunity to share some insights about how everything that's going on in the world translates into the process by which we invest for our tier one clients.
Absolutely. Well, Phil, as we've just heard from John, he mentioned the recent developments surrounding COVID-19 and the broader market. Could you talk a bit more about the specific risks that a tier one client could face in light of COVID-19 on their own portfolio?
Sure. So, it's an interesting time to be an investor. Clearly, COVID-19 has had a profound impact on the global economy, And in turn, it's having a big impact, obviously, on financial markets. Um, I would say from a tier one investors' perspective, it's a bit different because we know that the impact COVID's had, it's varied around the world. So a UK investor's experience has been different than the experience of an investor in the US, which is different from the experience of an investor in emerging markets. But with the tier one restrictions, we can't enjoy global diversification. And so what we wind up with is really a concentration of risk associated with global events like COVID-19 or more local events like Brexit. So with COVID-19, obviously, there's a lot of uncertainty right now about UK companies' earnings. That's being compounded by uncertainty around Brexit. We've got issues in terms of what monetary policy is doing to fixed income markets. And, the big impact is to drive yields lower, which is clearly a problem for bond investors. All of this uncertainty has weighed on the pound. So we've seen a lot of currency volatility over the last 10 months. And then getting back to fixed income, there's obviously a big issue with credit quality. And so investors are kind of wondering how much they can stretch for yield in terms of the risk that they're taking, that companies' prospects are diminished because of this pandemic, the longer it goes on. So all of this creates more risk for a tier one investor portfolio. But on the flip side, and this is where my team's work comes into play, we see dislocations like this as creating the greatest opportunities for investors. And so it really underscores the importance of having a robust and a thoughtful investment process for managing the risks, but then also trying to extract opportunity from a market environment like this.
Very good. Phil, what measures have the research team at Henderson Rowe taken to protect their clients from these dangers?
So starting with fixed income, one of the things we observed is that in late March, when the crisis was really starting to emerge, we saw a big spike in credit spreads. And that was reflective of concern that investors had that maybe this public health crisis was going to spill over and become a financial crisis. What we saw subsequent to that was central banks get into the market and just pump liquidity into bond markets. That drove rates lower, and it really, I think, sort of led to an abatement of the fears that investors had. At the same time, in the last few months, we've seen a wave of corporate credit downgrades. And we know that historically that precedes higher default rates. And so you've got this situation in which yields are incredibly low, and that goes for investment grade bonds, but also higher yielding securities. And at the same time, we know there's a lot more risk in terms of the credit quality of corporate issuers. So I think from the perspective of a tier one investor, the two key implications: one, we know that fixed income is not going to generate the yield that it once did. So it's not going to be a great source of return. And so it makes sense for a tier one investor to consider equities alongside fixed income in their portfolio. And the second implication relates to that diminishing credit quality, which is that when you build a portfolio, particularly in the context of tier one, where there are stricter constraints on the sorts of choices that we have in terms of fixed income, it's really important to consider credit quality and to consider the financial state of issuers. And so again, that puts more focus on the investment model and being able to make these distinctions between companies that are going to really struggle under COVID-19 and companies that might have an easier go of it. So that's the fixed income side. I mentioned equities, and that's certainly something that investors consider in tier one when bond rates are so low. With respect to equities, I said that different countries have had a different experience in terms of their financial markets in COVID-19. The UK's market has disproportionately suffered. So UK stocks, among major markets, they've taken one of the biggest hits. The implication is that there are cheap stocks everywhere. But on the other hand, a lot of those stocks are cheap for a reason. We would consider those value traps. And so when you're looking out across the market for investment opportunities in UK equities, it's important not just to look for stocks that trade at a discount to their pre-COVID prices, but you also want to focus on companies that have high scores on quality characteristics. So companies that we would say have a fortress balance sheet. These are companies with a really strong financial position, companies with cash flows, companies with realized growth that's less likely to be affected by COVID-19. And so again, it really comes down to having a strong investment process. Now, we'll talk in a few minutes, I think, about institutional quality. But a key point here is that Rayliant develops investment strategies for some of the world's biggest institutional asset owners. And so we've developed quantitative strategies that focus on factors that we know have historically outperformed. So we look for stocks that present attractive valuations, but we also look for companies that rate highly on quality characteristics, companies that have a tailwind in terms of market sentiment, companies that have quality growth at a reasonable price. And so our quantitative models focus down on stocks that meet those criteria. And then we have another layer, which is a fundamental review that's looking at how events like COVID-19 or Brexit are going to affect particular industries, how macroeconomic conditions affect different companies depending on those companies' exposure. And so combining that quantitative angle with this fundamental insight, that's going to produce stocks that are more robust to this issue of value traps that we often see when a market's beaten down like the UK stock market has been.
Brilliant. Thank you very much, Phil. The next question is, your background is working directly with our institutional partners. Could you talk a bit more about how your team leans on this experience when building your portfolios, and how does your investment process differ from what other UK investment managers are offering?
Yeah, so that's a good question. I think one of the keys to succeeding with institutional clients and also with our institutional partners is really sort of in contrast to what we see other investment firms doing, which is basically, if you look at retail money managers, they'll typically design a one-size-fits-all solution that addresses the average client. But we're keenly aware of institutional clients' specific objectives and constraints when it comes to how they want their portfolio built and what they're trying to achieve. And that happens to be something that translates really well into a tier one context. We know that tier one portfolios, not only are they trying to achieve this objective of delivering a good investment outcome, but there's also an immigration outcome that we're concerned about. And so this experience working with institutional clients where we've got a long history of developing bespoke solutions, that's really important when it comes to developing these bespoke strategies for tier one. They're really optimized based on the constraints of the program and also the fact that we've got slightly different objectives. So I think that's one important aspect of institutional quality, is having this ability to sort of engineer portfolios to custom objectives and restrictions. Another obvious feature of our institutional experience is that if you're catering to some of the biggest sovereign wealth funds and pension plans on the planet, they hold you to a really high standard. And it means that every aspect of our research process, every aspect of our investment process has to be institutional quality. So that means in terms of staff, in terms of the data that we're using, in terms of the proprietary models that we've developed, even things like IT infrastructure, all of that has to be built to satisfy an institutional standard of excellence. At Rayliant, our key investment personnel are known around the world, both in the industry and also in the academic community, for developing award-winning strategies and putting out award-winning research. We've got a team of PhDs and financial engineers who have a lot of experience building customized solutions for institutional clients. And all of that translates to what we do for Henderson Rowe. And in particular, it's very well suited for the process of building tier one investment portfolios. And then the last point that I'd make in terms of what makes our institutional process different is that Rayliant, as it happens, has a very strong presence in Asia. We've got an office in Taipei, we've got offices in mainland China. And so we speak the language of investors in that region. We know the culture and we better understand the way that Asian investors look at their portfolios. And so with respect to tier one clients coming from that part of the world, I think we've got a big advantage over competitors who don't have that Asian presence or that local knowledge.
Okay, that's brilliant, Phil. Thank you. That leads us on to our next question. If we could dig a little deeper, Phil, how does the tier one investor visa at Henderson Rowe compare with what our competitors are offering?
So in light of all of the risks that we talked about before, and particularly because tier one investors face these restrictions in terms of how they build their portfolio, they're limited in terms of diversification, they don't have all of the choices in terms of securities that they otherwise would. We think that basically stability, for lack of a better word, that is extremely important to tier one investors. And that's something that when you work for institutional clients, they want portfolios that are built according to a disciplined approach that use systematic rules-based investment processes. And all of that creates a portfolio that's much more secure than what we see a lot of our competitors providing. Our competitors often, if you look at their portfolio solutions, they can be quite whimsical. And in the context of tier one, where there are all of these sort of rigid constraints, that creates undue risk. I would say more generally, when we survey what competitors are doing, we find that often they've done the bare minimum to build a solution that meets the home office requirements. By contrast, at Ralliant and Henderson Rowe, we're really looking at creating a great investment outcome as our first and foremost objective for clients. And then we view all of the home office requirements, that's really a constraint on the portfolio. So that's a portfolio engineering problem. And that's exactly what our team is well-versed at developing. And so we can both meet the home office requirements, but we don't have to sacrifice in terms of key investment objectives, preserving clients' capital, and also trying to grow it over time. And then I think finally, a big difference is that we're using stocks and bonds to build these portfolio solutions. So this is a highly transparent approach in contrast to what we see sometimes happens with other investment firms, which is basically designing an esoteric and opaque investment scheme that's sort of manipulated to meet the home office requirements. The solutions that we build, we think they're very compelling, and they're also intuitive and totally transparent in terms of how we construct those.
Yeah, that's really well put. Thank you, Phil. And that does lead us very nicely onto our last question for you today. Are we building our tier one portfolios with the same data sets and models that we use for our typical client portfolios?
Absolutely. So that kind of goes hand in hand with this notion that everything that we do on the institutional side is basically creating new resources that we can deploy for private clients. And that goes for the tier one portfolios as well. So all of the data sets that we're using, all of the proprietary models that our team is building on behalf of sovereign wealth funds, pension plans, foundations, endowments, and so forth, we're deploying all of that in service of Henderson Rowe clients. And so I think in that sense, our clients are really benefiting in a way that they don't from competitors who don't have this institutional quality research and investment base.
Brilliant. Well, Phil, thank you very much for your time today. And I do hope that everybody on the call has enjoyed listening to the discussion with both John and Phil. We've got a couple of questions from our listeners that I'll put to you both. So the first question that we've got comes from Hilesh Chavda. The question is, given the restrictions in the investments, should the tier one investor portfolio be seen as a pot of money that may not give real growth, as it often was under the old rules where investments are essentially restricted to gilts? Or can it be seen as a portfolio that can offer real returns? Indeed, how do clients view this? And I'll start with you, John, if that's okay.
Yeah, so it's a really good question, and it's something that I think we've always historically been slightly ahead of the curve on. Even before working with Ralliant, 10 odd years ago, we like to look at the opportunity to actually grow an account, impress the client, and keep them on board and do many more years of work going forward. I think in the current climate, it's increasingly important to look at the portfolios as something that will grow, because actually, if you go down a route which notionally is safe, for example, just holding corporate bonds, actually, there's a good chance that you're putting yourself at undue risk, because the way in which COVID works and the great instability that we've had, that's really had an effect on corporate bonds in a way that could be akin to equities. So I think actually it's prudent, and in some ways it's safer, maybe slightly counterintuitively, to actually really look at portfolios nowadays with a view to growing it. So yeah, I think that would be my response to that. And Phil, I'd be interested to hear your thoughts on that.
Yeah, so I think this really gets back to the way that we think about the challenge of building portfolios. You know, we build systematic models that take in lots of data, and they're going to produce basically a scoring of every security that's in the universe. And you know, so with respect to tier one portfolios, it's the same process, the same models. We've just got a different universe, and it's a constrained universe because we can only invest in securities that are, you know, UK domiciled, UK listed, and that have, you know, that meet a set of criteria. But from our perspective, you know, it's basically about finding mispriced securities among that basket of stocks and bonds. And so we don't think that you have to necessarily view this as, you know, some money that you've set aside and it's not going to do anything until the tier one program is complete. To the contrary, you know, we view it as creating a portfolio that's going to deliver a great investment outcome. You know, capital protection on the one hand, but we like to balance that with capital growth because we think it's achievable even with this restricted set of investment opportunities for tier one investors.
Now, the second question that we've got, and I think it's aimed at you, John, so I'll let you answer this one, is from Rosie Romano. The question is, given the updated guidance on the rules around which companies you can invest into, how is Henderson Rowe ensuring that these conditions are met, and how will you approach undertaking the extension stage?
Yeah, so this is an interesting one, and actually at a number of similar events that I've been to, whether Zoom or live before the days of COVID, it's something that has been discussed quite a lot in terms of the criteria around the companies which you are allowed to invest in. So having talked, and obviously for us on the investment side, we rely a lot with the expertise coming from your end on the legal side. And I think we have a pretty confident approach to how we deal with this. Certainly, when you look at the criteria that the guidance now puts around the companies you can invest into, simply by making sure that the firm is incorporated in the UK, as historically has always been the case, and it is of a certain size, then that will essentially help you meet the criteria. My interpretation of the new rules is that essentially the criteria that are now in place really are trying to get round the situation where someone comes into the UK, their friend might have a business, it might have a small number of employees, and suddenly they're able to invest and really just get round the rules in that light. So I think the way in which it's structured now is to avoid that. Obviously, we only really invest in highly liquid and very large cap companies. So when you do that and you make sure that they are incorporated in the UK, have their offices here, etc., then you will actually meet all the criteria. Clearly, we're just coming up to the point over the next year or so when the first extensions will be done, and when we do that, we will be talking with all of our partners on the legal side to make sure that the letters that we produce and the certifications that we provide, they all meet a format that you're all happy with, because ultimately, as I know from having worked in this business for a long time, a key part of what we do at Henderson Rowe is making sure the partnership that we have with the legal teams is one that goes on throughout the lifespan of the visa. So yeah, we'll be doing a lot of liaison with you at that point. But ultimately, we're confident in terms of the way that we've interpreted the guidance today.
Brilliant. Thank you, John. A number of people we've spoken to have asked about the implications for the pound from Brexit. So I'll put this question to the both of you. I mean, looking more closely at that and the effects of the safety of the tier one investor portfolios, what are your thoughts on this? And John, I'll start with you if that's okay.
Yeah, sure. So the foreign exchange is an interesting one because it's that area of global markets that people love to talk about. It's a bit of a dinner party conversation. And I come at that from a particular angle, having formerly been a trader. What I do know about traders is that they love big news and they love things that they can jump on and take a position on. So for my money, I would say whatever happens with Brexit going forward, we will have some big news that comes out at some point, and that's going to have an effect on the foreign exchange rates. Now, the other interesting thing with currencies is that they're very commonly mean reverting. So over time, you might say over the period of a 5-year visa, actually, we could well get back to a historic average or be moving in that direction. In terms of the effects of that shift in the pound, would I ever advise people looking at a movement in the currency and then making a jump and investing all of their assets on the tier one, given a movement one way or the other? Probably not. I think the only thing that we would do is maybe spread the investment out over a period within which we were still meeting the rules. But given that tendency of traders to jump on board news and for FX rates to switch in one way or another to extremes which essentially get eroded over time, I think it's something not to be too concerned about. But on the investment side, as I'm well aware, there are other elements which mitigate those risks, and that's probably one that I can kick over to Phil.
Right. Thanks, John. I completely agree in terms of where an investor's focus should be, more on selecting the right securities as opposed to trying to perfectly time exchange rate movements. I think, clearly Brexit and also COVID, the uncertainty associated with these events has been weighing on the pound. And so, with respect to mean reversion, as we start to see that uncertainty resolved, you'd kind of expect possibly a sort of a regression to the mean or the long run historical exchange rates. But when you mention some mitigating factors, for me, one of the key factors is that we're investing in large cap securities in the UK. And we know that a lot of big UK firms, they've got significant exposure to foreign revenue. And so for some firms, the pound weakness could actually be a benefit in sort of a strange way. So it's not clear that all firms have the same exposure to uncertainty about Brexit and other events that's causing weakness in the currency. And of course, that's something when we do a fundamental review of stocks, that's going to be a data point that we look at. How exposed are particular firms to sources of uncertainty like foreign exchange risk? And that's something that it's one data point of many, but it's certainly something that can influence the way that we choose securities for a tier one portfolio.
Thank you very much, Phil. Well, Phil, John, thank you very much, both of you for your time today. And thank you to all of our guests for joining us. That does bring us to the end of today's webinar. So following this, John and I will follow up with each of you individually in the coming weeks to discuss existing and future clients that you feel would benefit from our tier one offering. So again, thank you everyone for joining the call today. We all hope at Henderson Rowe that you enjoyed the conversation, and we'll leave it there. So take care, everyone, and all the very best. Thank you.
Thanks, everybody.
Thanks, everyone. Bye-bye.
Take care.
Bye-bye.